Have you ever thought about which investment suits you best? Some people swear by gold, some go all in on stocks, and some stick to the good old fixed deposits. But here's the truth, investments aren't one size fits all. They depend on your goals like short term or long term. Today, we are going to uncover the six main types of investments, which one works best for short term and long term goals, and how to pick the right one that suits you. So, the feast is ready, it's time to serve. First things first, investments are personal. It all depends on what you need. Let me explain. If you're saving for something like your child's school fees next year or planning to buy a bike in 1 or 2 years, you have got a short term goal. On the other hand, if you're saving for your kid's college education in 15 years or building a retirement fund over 25 years, that's a long term goal. So your investments need to match these timelines. Now let's explore the 6 popular investment options and I'll tell you what works for short term and long term. Let's start with the simplest option, fixed deposits and recurring deposits. Here's how they work. With an FD, you put in a lump sum and withdraw it after a fixed time, like 1 or 2 years. With an RD, you invest a small amount every month and withdraw the total later. Here, the returns will be about 6 to 7% annually. Now, who should go for this? If you have a short-term goals like buying a car, paying school fees, or planning a trip in 1 to 3 years, FDs and RDs are great. They are safe, simple, and reliable. But remember, these aren't for long-term goals because over time, inflation eats into the value of your returns. Next is the ultimate favorite for many Indians. Yes, it's gold. But let's clear a common misconception. If you're planning to buy gold jewelry, then it's not considered as an investment. Why? Because you end up paying 20 to 25% extra in making charges and additional 3% in GST, which you'll never get back. So if you're serious about investing in gold, here's what you should look at. First, gold ETFs. It is like stocks for gold. The price of gold and gold ETFs are same. Let's say if price of gold increases by 5000, then gold ETF's price will also increase to the same amount, but it comes with no extra charges like GST and making charges. Next is my personal favorite, sovereign gold bond. It's issued by RBI. On top of gold price appreciation, these bonds gives you 2.5% annual interest and are tax free when you sell them. But here's a catch. New SGB allotments aren't available at the moment. If you want to invest, you can still buy SGBs in the secondary market through your demat account. On an average, gold typically gives 9 to 12% in the long term. So if you're planning to preserve your wealth and want a low risk option, go for gold ETFs or SGBs, but not physical gold. Next comes the real estate. It's a classic investment, but it's not for everyone. Here there are two types, self-occupied property and rental property. If you plan to live in a property, it's called self-occupied and it's not really an investment. It's a lifestyle choice. And the rental property. This is where you invest and earn rental income, but there are few cons. No one can confidently predict the price appreciation of real estate. Some properties may double in just 3 years, while some might not even double after 12 years. In India, the average gross rental yield for residential properties ranges between 3 to 5% and 5 to 10% for commercial property. This percentage will drop further if we consider various expenses associated with the property, such as property tax, registration costs, maintenance costs, and management fees. On top of this, if you want to liquidate it, you might not get buyers immediately, or they might quote a less price than your expected price. So, real estate is great for those with deep pockets and a long-term horizon, but for beginners, this might not be the best place to start. Next option is bonds. These are simple and safe. Here's how they work. You lend money to the government or companies and they pay you interest. Usually it is 7 to 11%. Now, who should invest in bonds? Retirees who want stability or anyone with a large corpus looking for regular cash flow with lower risk. But there's a catch. If the company goes bankrupt, you could lose your entire capital. So stick to the government bonds for lower risk. Now let's spice things up with stocks. Stocks are risky but exciting. You might lose 90% of your money by investing in some stocks, and some stocks might give you 200 to 300% in a year. But many might have developed desire to invest in stocks after hearing some stories. For example, you might have heard the story that in 2000, if you had invested in HM Motors shares instead of buying a bike, you could have gained 4 to 5 crores by now. Now let's calculate its returns. 20 years ago, this stock's price was just 26. Today it is trading around 4900. If we calculate its annualized return, it is 30%. But there is a catch. We are seeing those which have ended. Today, can we confidently name a stock that can give good returns after 20 years? No one can say that. Still, let's assume luckily you bought the share for 26. After that, it grows from 26 to 260. It will show 10 times returns. By seeing this 1000% returns, how many of you will stay invested? Many of them would have sold it due to emotional reasons. So it requires patience, which most of the people don't have. Unless you are ready to spend time researching and handling risk, direct stocks may not be for you. And finally, let's talk about mutual funds, the jack of all trades and master of flexibility. Why do I call it the best investment option? It's simple. With mutual funds, you are not only limited to one type of asset, you can invest in stocks, bonds, gold, and even real estate, all through a single fund. This versatility makes it the best option for everyone, no matter your financial goals. Whether you are saving for your child's school fees in 2 years or planning for retirement in 20 years, mutual funds have you covered. And the cherry on top is the returns. Over the long term, mutual funds can deliver 5 to 25% annualized returns depending on the fund and market conditions. So if you are unsure where to start, mutual funds are like all-in-one tool that simplifies everything for you. Finally, to wrap it up, fixed deposits and recurring deposits are great for short-term goals, with returns ranging from 6 to 7%, ideal for predictable and safe investments. Gold is a reliable option when invested through ETFs or SGBs, offering 9 to 12% returns. Real estate has the potential for good returns, but it's less liquid and unpredictable. On an average, it gives 3 to 5% for residential and 5 to 10% for commercial properties. And then bonds. Bonds are a stable option with 7 to 11% returns, best for those who prioritize safety over high growth. Stocks are high risk, high reward, with returns varying from minus 90% to 200% or more, best for those who can stomach the volatility. Mutual funds stands out as the best all-round investment, giving access to multiple assets like equity, gold, and bonds. Their long-term returns range from 5% to 25%, making them suitable for everyone. Ultimately, your choice depends on your goal, timeline, and risk tolerance. There's no one size fits all, so plan wisely. And that's all for this video. But wait, before you dive into any investment journey, there are 3 crucial steps you need to take. Skipping these steps could dent your investments and derail your financial goals big time. What's that? And that's the lead for my next video, so stay tuned. Until then, this is Sabrish signing off.